Kowalski Analysis. I'm your host, Rob Kowalski, and today we have on a great guest, Joe Brown. He's the founder of Heresy Financial. He's an entrepreneur, an investor, a public speaker, and host of the popular YouTube channel Heresy Financial, where he has helped millions achieve financial success by sharing key knowledge and insights on how the financial system works. So, man, I love your channel, Joe. That's why I reached out to you. I really think you have a different approach from what mainstream financial advisors seem to take. And yeah, man, I'm excited to chop it up. What motivated you to start the channel, and why the different approach?
Thank you, Rob. Yeah, well, I was a stockbroker for about 5 years. And during that time, I was helping the top 1% manage their wealth. And I was, drinking the Kool-Aid for a while, but I'm very curious by nature. And I continued to study to figure out, one of the things that led me into that career in the first place was because when my wife and I got married, I was broke. Tons of debt, no money, making less than minimum wage. And so I started just reading books on personal money management, and kind of fell in love with investing and the whole world of finance. And so I became a stockbroker after that. And, that curiosity about how to understand the financial system, how it works, how the economy works, stayed alive. And I found that inside the traditional financial system, that's really not a big concern. It was a big cause for concern for me. I didn't really like that. And so I ended up studying a bunch of stuff outside and figuring out some things that were considered heretical to the financial establishment. Things like Austrian economics. And it got to a point where I was like, okay, from everything that I've studied, I can tell this is how the economy works. But all the advice that we're selling, all the everything that we're telling people to do would work really well if the economy operated this way, but it really doesn't. And so it got to a point where, number one, I was miserable. I did not enjoy my job at all, making very good money. But I also was selling things I didn't believe in anymore. So I ended up quitting that. And that's when I started Heresy Financial, just with the goal to teach people how money really works. Because for me, the more I've learned and understood about how the financial system works, the more money I've made, the more money I keep, the better my investments do. So I wanted to help other people along that path as well.
Gotcha. Awesome, man. Are you Heresy Financial? I was like, I wondered if you were a Christian.
Yeah, so it's fun. I actually went to college to become a pastor. So my degree was in Christian ministries.
Okay.
And so, I talk to people today who are, talking about, younger people talking about whether they should go to college or not. And I'm like, hey man, like there are very few degrees that will provide you a positive ROI on that money that you're going to spend.
Right.
It took me quite a while, a lot of blood, sweat, and tears to get rid of the debt from that decision. And I wouldn't go back and change anything about it, but from a financial perspective, it was definitely a mistake. And so that's the direction that I was headed. And I just found through my interests and my skills, I was a lot better suited to a career in finance instead.
Yeah. Well, you're maybe still doing kingdom work on some level.
I don't hear that. Yeah.
Yeah. You don't hear the word heresy very often. So I wondered if you were a Christian. And, so I didn't share this now. First off, let me kind of give you some context. Normally the videos on my channel are usually about like patriarchy or marriage, biblical marriage. Used to be about sexual purity. So this is kind of a little different for people, but I want to tell them that, look, if you want to be married, you need to be able to provide, right? If you're a lot of guys who are watching my videos now and they want to be in, patriarchal marriage, but you have to be able to support that woman on some level. So you kind of want to pay attention to this advice that Joe's going to be spitting out today. Now, I became a Christian, like a real Jesus follower 24 years ago. And I had this radical encounter where I got baptized in the Holy Spirit. I actually prophesied, and God told me some things that were going to happen in the future. They actually have yet to happen, but to me, it looks like they're very close. He told me that the dollar was going to collapse and it was going to cause this global depression, basically where, maybe the money in your wallet becomes worthless or worth a lot less. Now, I don't understand macroeconomic trends like you do at all. But given what you know, do you see a global financial crisis on the horizon? And what indicators are you watching that suggest we might be headed for a severe economic downturn?
Yeah. So when you take a look at, let's just talk about the dollar real quick. The dollar has lost 98% of its value since we made the first move away from the gold standard when FDR outlawed gold. He confiscated all Americans' gold, and then he increased the price of gold. In other words, he devalued the dollar. So from right before that up until today, the dollar value has lost like 98%. And so you know, from that perspective, we're about 2% away from the dollar. But the other way to look at it is that today is the baseline. Okay, so how far down can the value of the dollar go from here?
Yes.
You could go another 98%. And then from there, how far down could it go? Another 98%. And so we are on this path. The way that the financial system is constructed is one where it is driven by an increase in debt. All dollars are loaned into existence, and that might be like a hard thing to wrap your mind around. But when you go put your dollars in a bank, when you get your paycheck, the bank doesn't just hold on to those. They've got to go make money with that so that they can keep the lights on, and, you know, pay their executives big bonuses. And so if you give them, you know, 10 grand, they're going to take 9 grand of that and they're going to go loan it out to somebody. But then you think about, okay, well, where does that loan go? That loan goes to somebody and it gets deposited into a bank account. Well, now that's a deposit for that next bank, and they take 8 grand of that and they loan it out. Meanwhile, you can still go and get your 10 grand out of your bank account. They're just hoping that everybody doesn't go all at once to get their 10 grand out of their bank account. And so the money supply is constantly expanding as a result of this debt expansion. Now, at some point, it can reverse if debt starts getting paid back, if prices start to fall. This would be called a deflationary deleveraging. The last time we had this happen was the Great Depression. And since then, the Federal Reserve, the central bank, has said, we don't want that to happen again. So anytime we see signs of, hey, this is going to start tipping over and the money supply is going to start shrinking and debt is going to start getting defaulted on, we're going to step in to stop that from happening. And the way they stop that from happening is by printing money, by lowering interest rates, bailing out banks, bailing out the government, sending out stimulus checks, things like that. So we're in this game where the money supply constantly increases, the amount of debt in the system constantly increases. And they're trying to thread that needle between continuing to allow that to happen without tipping over into hyperinflation. And at some point, they will fail at that. So far, they haven't. The one thing that kind of makes their job easier is that everybody in the world uses dollars. And so, yes, Americans have a lot of debt. Yes, the American government has a lot of dollar debt. But when you look at all of the debt around the world, most of the debt is denominated in dollars. So you look at companies, organizations, other countries, they've borrowed money, but it's not their own money that they borrowed. A lot of them have actually borrowed dollars, which means there's built-in demand for dollars because they have to go get dollars from someone else in order to pay back that dollar debt. And so there's a lot of debt here. There's a lot of money printing going on, but around the world, there's a lot of demand for dollars because there's so much dollar debt. There's a lot of people and companies that need to get more dollars. And so that helps right now. It's not going to be there forever. But that certainly makes the Fed's job easier. They can print more money without as much consequence as maybe other nations would have.
If you're a man or woman looking to be in a traditional, conservative, patriarchal marriage, but you're having a hard time finding the right person to deal with, I created a program exclusively for men and women like yourself to help them level up and find each other. There's an application link pinned to the profile below in the description. Take a moment to click that, fill it out, and we would love to jump on a one-on-one call with you to see if you would be right for our program. Look forward to speaking. So you don't see like BRICS and some of these other things coming on as a potential threat to the dollar being the world's reserve currency? Because if that was to happen, like we were to lose that status, the potential for that, like for example, the petrodollar, something I learned about a while back, and Saudi Arabia is selling their dollars or their oil only in dollars, but recently they came off of that. I heard it was like some 50-year agreement just ended, and now they're taking different currency to trade their oil. And I guess I don't know if it was Ray Dalio or one of them talked about if we lose that reserve currency, now all of a sudden the need for the dollar by all these foreign countries isn't there, so they could just ship their dollars back to the United States because they don't need them to buy oil anymore. And now we have a surplus of dollars, and then, you know, with like anything else with supply and demand, that's when we could go into a free fall. So I don't know if you see any danger of that. I'm really just kind of looking more to hear what are your strategies that you're giving clients. I love the video that you, probably my favorite video you put out was the one about how to build wealth pretty much like on autopilot over time, where you divide it out into 3 buckets. And I'm kind of trying to follow that. I'd love to hear your thoughts on that. So like, if you know, what would you suggest somebody does now in this economic climate that we're in? Is it that scenario? Is it that strategy? Even with what I just said, if that was to come to pass, that would still be a good strategy to follow? And could you tell everybody what that strategy is quickly?
Sure. Yeah. So great question. The strategy, very briefly, is about 1/3 in real estate, about 1/3 in stocks, or in private business. And then about 1/3 in savings reserves, which for me, most of that is gold. And so I'm personally not concerned at all about an imminent collapse in the dollar. There's too much demand for dollars around the world for that to take place. The catalysts that could cause that, number one, are unlikely, and number two, are preventable. So in terms of that being something we need to be worried about right now, I think that's incorrect. Things like BRICS, the petrodollar, all those things, those are very small scale in terms of the overall demand for dollars around the world. That doesn't mean, though, that it's not something we need to be worried about on a long-term time horizon. It's like the dollar's purchase, whether it goes to zero or not, the dollar's purchasing power is being eroded quickly over time. And I expect that to accelerate over the next 10 to 20 years. We are in a position right now where the federal government must print money or else they default. Right. That's the only option. The amount of spending that they have to increase from Social Security, Medicare, military, not to mention the interest on the debt, those things are expanding at an exponential pace. There's not enough money for them to tax, and there's not enough cash in the system for them to just borrow it to continue those spending. They have to print money in order to create enough money for those spending needs. And what that does is that causes inflation because it increases the money supply. When you have more money chasing the same amount of stuff, it makes prices go higher, just like 2021. Trillions of dollars in cash goes out into the economy. Well, they didn't print more shoes. They didn't print more cars. They didn't print more food. They didn't print more. So that pushes prices up. Everybody has more spending power, goes out to buy the stuff that didn't increase. So now the prices are higher. That happens. That's going to probably continue to happen for the next, I would say, 10 to 20 years. We're in this cycle where the government has to deleverage themselves. And so the way they do that is through inflation. They did, just by the way, if anybody wants to go look up the debt to GDP chart for the last like 150 years. We're in the same position as we were at right at the end of World War II. The government's 120% debt to GDP, a lot of spending there. And then the way that they handle that is through the Fed's yield curve control, lowering interest rates. So we have an inflationary deleveraging where they print a bunch of money. They lock down interest rates for the government to get a cheap borrowing rate, but interest rates for everybody else went through the roof. And so we're going to have higher inflation, higher interest rates as that burden gets offloaded onto the economy. So then the way to handle it, which is what you were getting at, is very similar to kind of what you would do if you were expecting just a collapse of the dollar, hyperinflation, because these things are this is the building blocks of how you protect your portfolio against government intervention like that, whether it happens today or whether it happens over 20 years. The first part of that is real estate. The number one thing that people always say about it is, land, they're not making any more of it, right? So it's a scarce resource, scarce asset. So that's number one. And so when more money gets printed, that's more money chasing the same amount of goods and services in terms of land, because, they're, again,
you don't think we're in a bubble there with the real estate? Do you think there's a real estate bubble right now? I just saw how fast it was. I lost a couple homes in 2009 or 10 when the market collapsed, and it was brutal, man. I had one that had a mortgage of 170,000. It sold for 51,000. It was crazy. It was literally, appraised for 170, 18 months before that. and ended up selling for 51. So I saw the way it went up so quick over the last few years, and I thought, I wonder if we're not just seeing a repeat of that. But so you think still though real estate is a pretty safe bet?
Yeah, the position that we're in today has zero resemblance to the position before the great financial crisis. The only similarity is the price. Everything else is different. So whenever it's a price thing, you have to ask, okay, why is the price higher? So it's that the price is not an indication of a bubble. Price is an indication of demand outpacing supply. And so you look at where's the demand coming from and why, where's the supply coming from and why. And in the case before the financial crisis, it was like adjustable rate mortgages, people owning multiple homes, more homes being built than there were people to live in them. There was all the crazy stuff happening with the banks. So there was a lot of stuff going on there that was mathematically unsustainable, just from the financial side. Today, it's an entirely different situation. So number one, the reason why I asked compared to what is because house prices are expensive compared to dollars.
Right.
But so is the stock market. So are eggs. So is beef. So are cars. So it's like if everything's a bubble, maybe it's just the value of the dollar that's going down. When you look at real estate priced in gold, it is nowhere near the top. So the number of ounces of gold you need to buy an average house today is...
Hold on, say that again. I want to make sure I understood that. The real estate compared to gold, what was that again?
Yes. Real estate priced in gold is nowhere near where it was in...
Oh, because gold was cheaper back then? Or what do you mean?
Well, gold was cheaper, but houses, I mean, in many areas were cheaper as well. So yeah, when you look at the number of ounces that it takes to buy the average house,
I see.
there was very clearly a bubble back then. In dollar prices and in gold prices, priced in gold. Today, that's not the case. And so you have to ask, okay, well, what other metrics can we look at? So where is the demand coming from? Well, there has been, ever since the financial crisis, there has been underbuilding nationwide, not everywhere. There are some places where they've been overbuilding for sure. Nationwide, there's been underbuilding. They've been building a lot fewer housing units per people who are entering growing up, exiting their parents' homes, per people who need a place to live. There are fewer people today that live in each housing unit than there used to be. If you want to push it all the way back to like the 60s, there used to be an average of like 4 or 5 people per housing unit. Today, there's like 1.5 people per housing unit. So there's fewer housing units being built per person, and there's fewer people living in each housing unit. And not to mention the fact that a lot of the immigration statistics are not included in the real estate versus population statistics. And so we've just got this massive amount of demand that there's not enough housing supply for. And that is not changing anytime soon. There's still not anywhere near enough building to compensate for that. The other part is the financial aspect, which is interest rates were so low that 40% of homes are owned without a mortgage, which is crazy compared to where we were, 15 years ago. Of the mortgages that do exist, something like 60 to 70% of them are below 4%. And so everybody who bought a house prior to 2022, they literally can't afford to sell right now, because whether they sell and go rent or whether they sell and buy something else, the new thing that they move into would be more expensive than what they're currently paying for. So people are stuck. There's very few. The very fact that people can't buy means that most people who would want to sell can't sell.
I got it. You don't need to explain that any further, because I kind of interrupted you there. I apologize. But you said, going back to the strategy. Okay, so 30% in real estate. 30%,
yes, 30% in real estate. And I would like to make a note of that it's not just land. It's not just any type of real estate. It's not just, it's cash flowing real estate where you have a fixed rate mortgage that is below the rate of inflation, and that the cash flow from the property pays for the debt service. If you're getting an adjustable rate, you're going to get screwed. If you're getting something that's, on the commercial side where it's 3, 5, 7 years and then a balloon payment, you're going to get screwed. So in an inflationary environment, you want as long of a term as possible with a fixed rate. And you need to have the cash flow from the property cover all the expenses and still cash flow after that.
So it's an asset at that point. It's an asset on a balance sheet, not a liability, as Robert Kiyosaki would say.
Correct.
Okay,
Yep,
got it.
absolutely. And that way you are actually taking advantage of inflation, because
Mhm.
the asset then really becomes the debt, because the real estate becomes a vehicle to short the dollar. When you short
Mm,
something, you borrow it and exchange it for something else. That's what
right.
you do with dollars. You borrow the dollars, exchange it for real estate. So the real asset is shorting the dollar. The vehicle to do that is the house. You just need to make sure that it can pay for the cost of that debt.
Love it. Love it. Okay, got it.
So that's about 30%. Or about a third. The next third would be in business. And for most people, that's going to be in stocks. A lot of people, that's going to be in your 401k, your IRA. But for entrepreneurs, this is something I see all the time. I work with people who are like, they've got this financial guilt where they're like, man, I know how to make a business. I know how to grow a business. I know how to, increase my own personal income. And, I make good money and I just put it in the bank and I don't know what to do with it. I need to learn how to invest in stocks. And it's
Mhm,
like,
mhm.
well, a stock is just somebody else's business. If you know how to run your own business, maybe take a chunk of that and reinvest in your business. You're going to get a way better return from doing that 100 times out of 100 than giving it to somebody else who runs, a large publicly traded business.
Right.
Um, and so there's nothing wrong with taking the majority of that 30%, that third of your net worth, and having that be in private businesses, whether it's your own private or publicly traded companies like stocks.
What's your favorite sector right now, business wise? I know you mentioned stocks in different sectors. Do you like defense, or what are you looking at?
Um,
AI? I heard people talk about AI.
I'm pretty bearish on AI. Actually, I think it's very, very overvalued, and we're about to start to see kind of an unwind of a lot of over. It's been overhyped a lot.
Sure.
Um, and I could be wrong about that. I've been wrong about it for a while. So we'll see. Um, the the it's not necessarily sectors right now. I mean, I think commodities are still going to be doing very well. I'm bullish on energy, especially like uranium. Um, but there's most likely, in my opinion, going to be a shift back into value.
Mhm.
There's with the things that we have coming up in the economy, I'm a lot more bullish on small business, on value, on materials, reshoring, manufacturing, the physical stuff that people
Food.
need a lot.
Medi-
Food, yeah, yeah,
yeah.
yeah.
Gotcha. Okay.
A lot of the stuff that Warren Buffett invests in.
Okay. Okay. Boring stuff.
Um, yeah, the boring stuff, exactly.
Or
Yeah,
alcohol, even, right? Food, alcohol, stuff like that.
yeah.
Yeah. Okay.
Yeah, the stuff that, if you push it to its extreme, like if you look at the Weimar Republic in Germany, the fall of the Weimar Republic, after their hyperinflation, it's like the only people who got rich during that time were the farmers, because they were the
Mm,
only ones who had the ability, had the land, produce something for them that people would still buy no matter what it cost.
I see.
And no financial engineering there. It was like, hey, eggs cost $1 million now, like take it or leave it, and people
Yeah.
paid.
Right.
So
For, yeah. Good stuff. Okay. So 30%, back to what you said, 30%
yeah,
in uh, stocks or business,
uh-huh.
30%, what was the thing before
In
that?
real estate.
Real
Real
estate.
estate.
And
Yeah,
then,
yeah.
were you going to say more with that, with the stocks? Or
No,
was that
that's it. I just want to. Index funds are fine. I prefer giving yourself some time to study and learn some basic stock valuation.
Mhm,
Treat yourself as if you're an active investor, not an active trader, just an active investor. Where
mhm.
if you buy something, you're not allowed to sell it for 20 years. Like, would you still buy it? It's like, would you still buy that AI stock if you can't sell it for your 20 years?
Right.
And so, an index is fine. A lot of people would choose an index fund if that was their mentality, and they'd probably be fine. But I would say don't go into it with a passive mindset, because passive investors tend to be passive losers. There's really no such thing as passive investing. The more passive you get, the lower your return. So treat it as if you're, managing money for, a 20-year time horizon, or something like that, and that you can't just sell.
Yeah, I'm going to put a link to that video in the show notes so that everybody can go back and watch that, because you did such a brilliant job of breaking all that down. And it's for someone that doesn't have a plan or didn't really have a firm plan, it really gives you a solid framework. But keep going. So that what's the next 30% is cash
Not necessarily cash, but savings, reserves. And
savings.
so
Okay.
I need to specify that because if you have 30% of your money in cash, inflation is going to destroy you.
Yes. Yes.
And I know so many people that for the last 4 years, they've just been plowing money into their savings account, and, 50 grand, 100 grand, 200 grand. They're like, hey, 2 years ago, I could have bought a house. Now I can't even afford the down payment.
Right.
And not to mention they're, not even paying attention to high yield savings accounts, things like that. So inflation has literally just been destroying their money.
Yes.
And so of that 1/3 of your money that is in reserves, you want to put it in something that historically preserves your purchasing power against
Mhm.
inflation, deflation,
Mhm.
anything.
Mhm.
And for thousands of years, that has been gold. I'm not sure if you talk about gold on your channel or how
I
much,
do quite a
but
bit.
like if you look at the salary of a Roman centurion, that job is very similar to an army captain today. Priced in ounces of gold, it's in the same range. Like
Mm.
an army captain gets paid the same amount in gold as a Roman centurion did.
Wow.
When you look at the cost of a 3-piece custom tailored suit 200 years ago in Greece,
Mhm.
it's about 1 to 2 ounces of gold. Well, that's the same today for a custom 3-piece tailored suit.
Mhm.
And so things that don't get cheaper from technology, the purchasing power of gold stays the same. There are
Mhm.
some things where the purchasing power of gold just grows a little bit over time, like food or cell phones, technology, things where
Mhm.
technology over time will make it a little bit cheaper.
Mhm.
And in that case, then the purchasing power of gold grows. But for most things, it just kind of stays relatively stable. And so that's a long-term thing. But the purchasing power of gold, it's like that's a savings account. So I use gold. I put about of my net worth about 20% in gold. So that's
Mhm.
of the 30% that's in savings. That would be about 2/3 of that
Gotcha.
is in gold, and that's just my savings account. So if asset prices dump and there's a deal, well, now I've got dry powder that I can go buy assets that are on sale.
Mhm.
Um, if an emergency happens and I need to rely on something to spend, I've got dry powder. I don't have to sell assets. And
Mhm.
so gold is a savings account. It's not going to make you rich, but it is going to preserve your purchasing power.
Love that.
Um, and then I take about 5% in cash because we live in a cash world where you need, and I say cash, a high yield savings account, money market fund, all those are good.
Mhm.
That's what your expenses are in. And so you need to have dollars because
Right.
everything you buy is in dollars. And so
Yes.
going to have about a 5% in dollars. And then I put the other 5% in Bitcoin because there's a good enough chance that it becomes money
Right.
universally in the future.
Right.
If it does, the price of Bitcoin has to be many, many, many times higher than it is. If it
Mhm.
doesn't, it's going to go to zero. And so I usually don't recommend starting out with more than 5% because
Mhm.
it's an asymmetric bet. You could lose everything that you put into it. And if it goes, then it increases your portfolio a lot. If it doesn't, then you only lose 5%.
Love it, man. And then the last 10 from was speculation, right? Where you can actually take a
Yeah.
shot and gamble on some stuff, right?
Yeah, because I'm saying a third, but really it's 30% in each of those big categories. That leaves 10% left over, and you can do things like hedging. You can buy puts on real estate stocks to protect your real estate on the indexes that you're buying or the stocks that you're buying for your investments, to protect them from falling in price. Which, if people aren't aware, it gives you the right to sell at a certain price, and so
Mhm.
it provides you basically like an insurance policy against it falling. You can use that for speculation, where it's like, hey, I heard this hot stock tip. My Uber driver said he's getting rich from this one stock, this penny stock. I'm going to go buy some. It's like, yeah,
Right.
you got to have some room to do that because best case scenario, you're going to make some money from that, but you don't want to be all locked up because then you have the temptation to sell things when they're low and then bet the farm. You want to have a little bit that you use to speculate with, and maybe make some money with.
Yeah, you only need one of those to hit every so often to
Yeah.
more than make up for the losses. You basically is what you said.
Yeah.
Um, I know you don't have a lot of time. I appreciate that you came on and spent some with us. How does somebody work with you if they want to? Because again, the advice that I see you giving is not kind of run of the mill, and I think everybody needs to go check out your videos, but especially the one that I mentioned. Again, we'll put the link here. But how does somebody work with you? I'm guessing you have to be fairly high net worth, right?
Yeah, well, the first place I always tell people, just like you said, find me on YouTube because I'm constantly putting videos out there, just free education. My whole goal and mission is to make as much education available to everybody as possible, so that you know how money works. if you want more tactical and strategic advice on constructing your portfolio, getting alerts for asymmetric setups in the market, training on more advanced strategies using things like options, I do have a coaching program. I call it Heresy Financial University. And that is number one, it's the training where I teach you how to do everything. But number two, I actually send out setups, alerts on, hey, here's an opportunity, here's the potential gain, here's a potential loss. And so you do have to be somewhat experienced with investing. If you've never traded a stock before in your life, you're probably not going to be able to take advantage of the stuff that we're doing. And then usually I recommend I prefer accredited investors. I don't have, it's not, it's not something that's a hard stop. And so if you're not, it's not going to be on an application or anything like that. But I do have that private program, and we got quite a few members now. We do live streams. In fact, after we get off this call here, I'm doing a monthly live stream with the group right now. And so that's my coaching program if you want a little more.
Awesome, man. Thank you so much. The best place to connect with you is where you just said. What about Instagram or subscribe on YouTube, I'm guessing?
YouTube. I'm pretty active on Twitter, and then I post my shorts on social medias as well. So pretty much anywhere you search for Heresy Financial, you'll be able to find me.
Awesome, Joe. Thanks so much for coming on, man. I know your time is valuable. I really appreciate it.
Yeah, thanks for having me, Rob.
If you enjoyed this video, don't forget to hit the thumbs up button. Leave a comment below with your biggest takeaway, a question, or even an objection for that matter, and subscribe to my channel before you leave. I'd greatly appreciate it, and feel free to share this video with a friend.